Gold is approaching a massive liquidity zone, and smart money is already engineering their next big move. Listen closely, because my primary focus today is a precise structural sell setup, but there is a strict condition that absolutely has to happen first. Most retail traders, they're looking at the exact wrong level right now. Let's jump straight into where the institutions are actually targeting in today's analysis.
On the H4 timeframe, our primary draw on liquidity is sitting right above us. We're targeting buy-side liquidity resting at 43.4290, stretching all the way up into the 43.66 level. But here's the problem. Smart money might be preparing an alternative trap. We are simultaneously stalking a potential sell setup if sell-side liquidity below the 43.20 zone gets aggressively attacked first. The institutions are literally boxing retail in on both sides.
So here is your executable blueprint for today. The higher time frame daily bias remains bearish, but right now we're trapped in a highly aggressive H4 bullish retracement pulling out of a deep discount. The primary institutional magnet here is that unmitigated H4 fair value gap between 434.2090 and 43.66, but you've got to pay attention to those vulnerable intraday lows at 42.9580 and 42.8705. The current setup? We wait. Absolutely no execution until we see that M15 confirmation.
Section 1. Smart money liquidity draw.
Let's look at why institutions are moving price this way. Down here at 4041.40, smart money engineered a massive purge of a major long-term structural low. They triggered a huge wave of retail sell stops, trapped breakout sellers into thinking the floor was completely falling out, and then aggressively sponsored this violent reversal right back into a premium array. This is your classic institutional liquidity sweep. Stepping down to the H1 timeframe, notice the violent displacement. We printed a confirmed bullish market structure shift right at 4248.25. Every minor intraday drop is being rapidly met with intense institutional buying pressure. They're leaving trailing buy stops fully exposed as price expands, which is essentially drawing the market higher toward our primary targets.
Section 2. The geopolitical macro catalyst.
Now this macro narrative completely aligns with our technical order flow. The US and Iran just announced a finalized peace deal. The US is lifting its naval blockade, the Strait of Hormuz is reopening, and $12 billion in frozen Iranian assets are being released to the market. The result of all this? Safe haven demand has absolutely collapsed. WTI crude dropped nearly 4%, down to 79.40. The US dollar index plunged to 99.50, and with inflation fears easing, the odds of a Fed rate hike have plummeted down to just 27%. This macro injection is exactly what's fueling the bullish retracement we're tracking on gold.
Section 3. Executable ICT trade plan.
All right, here are your two institutional execution scenarios. For a buy, we want a discount retest. We're looking for an entry zone inside the M15 fair value gap between 43.05 and 43.13, with a tight stop loss at 42.92. Our final take profit is that H4 FVG up at 43.4290. But if the market gives us a premium rate first, scenario 2 triggers. We'll look for a sell entry at the 43.30 mitigation block, targeting the 42.90 zone. Remember, execution only happens when smart money actually prints an M15 market structure shift or change of character. If there's no confirmation, there is no trade.
Now, timing is everything because institutions engineer liquidity around specific kill zones. We're anticipating a pre-London internal sweep, followed by some serious volatility during ECB President Lagarde's speech. Pay very close attention to the New York transition, because this is prime time for a stop hunt or a false breakout. Later on, US data like the Empire State Manufacturing Index will provide the secondary volatility injection needed to finally rebalance those fair value gaps.
Which brings us to a really critical question. With all these moving parts, where are retail traders getting trapped today?
Look at this. The current market price is hovering right around 43.27.29. Novice traders see these green candles and they buy right here. But buying at this level means buying into the absolute premium of the M15 impulse leg, directly beneath a minor resistance ceiling. This is the exact scenario most traders are completely ignoring. You'd be buying exactly where smart money wants to sell to you in order to engineer their discount pullback.
This level right here becomes critical. Our hard invalidation level is 4287.00. A sustained break and closure below this level completely shifts the immediate institutional order flow right back to bearish. If that happens, all long setups are instantly canceled.
Section 4. Final recap and warning. Here is your institutional playbook for today. The higher time frame draw remains 43.42.90. Your immediate action is to wait for M15 confirmation. Do not buy premium pricing. Let retail fall for the trap. Watch closely for that pre-news liquidity raid during the London or New York transition. And above all else, strictly risk a maximum of 0.5% to 1% per setup. We trade to survive first, then we trade to win.
If you enjoy this type of outcome-focused, institutional-grade market analysis using ICT and smart money concepts, be sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these exact setups, you can find the FXTM account link provided in the pinned comment below.
I'm going to leave you with this final thought as you look at your charts today. When you enter the market, are you the one engineering the liquidity, or are you the liquidity? Wait for your edge. I'll see you in the next explainer.